Right now, the Australian dollar is printing 0.7134, and I need you to look at this number very closely because it's sitting exactly on the 50-day moving average after one of the ugliest GDP prints this year. The herd is dumping Aussie like the trend has already broken. But here is what they are missing. The weekly chart is a strong buy. The monthly chart is a strong buy. What we might be witnessing is the nastiest bear trap of the quarter. In the next 60 seconds, I'm going to show you the one danger zone that could wipe out late shorts and the one hidden opportunity that could deliver 3-to-1 returns. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, complete with stops and targets that you can screenshot right off the screen. Let's get into it. This is your instant market verdict for the next 24 hours. The session bias is not chasing the sell-off. It is fading the panic with surgical precision. The short-term time frame, the 1 hour, the 4 hour, and even the daily, are all flashing sell. But I have seen this movie before. When the weekly and monthly trends are screaming strong buy and price suddenly pierces down into a high-volume demand zone, that is not a signal to join the sellers. That is a signal to wait for the trap to spring. Write this number down, 0.7116. If we get a 4-hour candle close below 0.7116 today, the entire weekly structure resets, the uptrend is compromised, and I will flip bearish without hesitation. But as long as 0.7116 holds, every tick lower is a potential liquidity grab designed to fuel the next leg higher. Here is the micro insight that matters. The herd is positioned heavily short. The latest commitment of traders data shows speculative accounts have been piling into short Australian dollar contracts. When everyone is already leaning one way, the fuel for the opposite move is massive. This is the setup where you don't want to be on the crowded side. You want to be the one taking their liquidity when the squeeze ignites. Now let's walk the chart from the very top down, because the multi-timeframe conflict is where the real money is made. Pull up your weekly chart. The 200-week moving average is way down at 0.6880, and price has been trading comfortably above it for months. The trend structure is clean higher highs and higher lows, and this current pullback is tagging a rising trend line that connects the October and February lows. That trend line comes in exactly around 0.7120 to 0.7116. This is not random. This is a structural support zone where buyers have stepped in repeatedly. Now drop to the daily. The daily trend is technically a sell, and that makes sense because we have broken below the 20-day moving average at 0.7166 and the shorter 5-day at 0.7157 and the 10-day at 0.7165. Price is trading underneath that entire moving average cluster, so the daily picture looks heavy. But here is what most traders miss when they look at a sell signal on the daily. The daily sell signal is unfolding directly into a weekly support zone. That means the sell signal is happening in the exact location where we should be looking for a reversal, not a continuation. That is the trap. That is how you spot the fake breakdown before it happens. Now zoom into the 4-hour chart, because this is where the hidden divergence changes everything. The 4-hour trend is a strong sell, no question. Price has made a series of lower lows, and the moving average ribbon is sloping down. But look at the MACD. The 4-hour MACD line is printing a 0.001 reading right now, basically dead flat on the zero line, but the histogram has started to carve higher lows while price made a lower low yesterday. That is a textbook hidden bullish divergence. In plain language, the sellers are pushing price lower, but the momentum behind those moves is evaporating. It's like a car running out of fuel while still rolling downhill. Eventually it stops. The RSI on the 4-hour is at 46.25, not even oversold, which means if we do get a spike down into 0.7116, the RSI could dip into oversold territory and create a double-barrel reversal signal with a divergence. The stochastic is at 66, still pointing down, so we may have a little more short-term pain, but that is exactly what builds the spring on the 1-hour chart. We are grinding along support at 0.7134. That level is not random. That's the 50-hour moving average on some custom settings, but also a key pivot from last week's consolidation. The immediate resistance cluster is right above us, 0.7153, the first support turned resistance, then the 5, 10, and 20 moving averages all bunched between 0.7157 and 0.7166. A single 1-hour close above 0.7166 would flip the short-term structure back to neutral and open the door to 0.7190, the first major resistance, and then 0.7208 and 0.7227. These numbers are everything. Write them down. Now let's talk cross-asset linkage, because the Australian dollar is the world's China proxy, the ultimate risk barometer, and that matters profoundly right now. The Australian dollar is moving tick for tick with daily and iron ore futures and the Shanghai Composite Equity Index. Overnight, we saw Chinese equity futures come under pressure, iron ore slipped, and the Middle East headlines added a risk-off pulse. That was the immediate trigger for the Aussie sell-off. But here is the nuance. The GDP data that came out of Australia was disappointing. Growth came in below expectations, but it was accompanied by sticky inflation components. That means the Reserve Bank of Australia is not about to cut rates aggressively. In fact, the yield spread between Australian 10-year bonds and US Treasuries is starting to widen again in Aussie's favour. So while the knee-jerk reaction was selling AUD on growth fears, the rate differential story is quietly turning supportive. That's the divergence that institutions see and retail misses. The fundamental driver for the next 1 to 2 weeks is the tension between slowing growth and a hawkish RBA stuck in an inflation fight. Throw in China's next Caixin Services PMI tomorrow, and you have a massive catalyst. If that Chinese data surprises to the upside, the risk-on switch flips instantly, and Aussie shorts get run over. The 1 to 2 week directional lean is cautiously bullish as long as 0.7116 holds. The invalidation is a weekly close below 0.7116. If that happens, the macro thesis breaks, and we could see a fast move to 0.7039, the 100-day moving average, and then the 200-day at 0.6880. That's the line in the sand. So let me ask you directly, do you think the Australian dollar bounces from 0.7116 this week? Comment bounce or break right now. I'm tracking consensus and I'll call out the results in tomorrow's video. Now we are entering the most important section of this entire breakdown. Most people click away at this point because they want the idea but they don't want the plan. That's exactly where the money is made. Keep watching because I'm about to give you 3 precise trade setups, each with exact triggers, stops, and risk-reward logic that you can screenshot and execute. If you skip this, you're leaving pips on the table. The first strategy is the sniper, the conservative play for traders who want confirmation before committing capital. Here is the logic. We are not catching the falling knife. We are waiting for the trap to spring and then stepping in after the market proves it's a fake breakdown. The trigger for the sniper is a 4-hour candle close above the moving average cluster at 0.7166. Once that happens, we know the sellers have lost control. The entry will be a pullback to 0.7170, a level that will act as support after the breakout is confirmed. The stop loss goes at 0.7129, just below the 0.7134 support and below the 50-day moving average, giving the trade room to breathe while protecting against a deeper flush. Take profit 1 sits at 0.7208, the first major resistance, which would deliver a solid chunk of pips. Take profit 2 extends to 0.7227, the top of the resistance cluster, offering a risk-reward ratio of roughly 1 to 3.1. The setup is completely voided if we see a daily close below 0.7116. If that occurs, the bullish structure breaks and we stand aside. This is the cleanest, highest probability entry on the board, the sniper, conservative, entry, 0.7170, after 1-hour pullback, following 4H close above 0.7166, stop loss, 0.7129 take profit 1, 0.7208 take profit 2, 0.7227 risk, reward, 1:3.1 are invalidation, void if daily close below 0.7116. Now the second strategy, the active trader. This is for those who want a standard mean reversion entry without waiting for the full breakout confirmation. The logic here is a direct bounce off the 50-day moving average and the 0.7134 support level. We are looking for a 1-hour bullish engulfing candle that closes back above 0.7138. That candle would confirm that buyers are defending the zone and that momentum is shifting intraday. The entry is 0.7138 on that engulfing close. The stop goes at 0.7110, just underneath the invalidation zone, below 0.7116, giving protection against a false bounce. Take profit 1 is 0.7165, the confluence of the 10 and 20-day moving averages. This is the first area where short-term sellers will try to reload. Take profit 2 is 0.7190, the resistance that aligns with the previous breakdown point. Once take profit 1 is hit, move the stop to break-even and trail it under each subsequent 1-hour swing low. This strategy gives you a high hit rate on bounces from magnet levels, and the risk-reward sits around 1 to 2.4 if both targets play out. The key risk is that the engulfing candle fails and price slices through 0.7116. If that happens, the stop protects you and you live to fight another day. Before we move to the third strategy, type your Australian dollar to US dollar range for tomorrow in the comments. Give me a high and a low. Let's see who is aligned with the levels we just mapped. I read these comments and I'll highlight the most accurate calls tomorrow. The active trader, standard, entry, 0.7138, 1H bullish engulfing close above 0.7134, stop loss, 0.7110 take profit 1, 0.7165 take profit 2, 0.7190 risk, reward, 1:2.4 trailing rule, move stop to break even after TP1 hit, trail under 1H swing lows. Now the third strategy, the aggressor. This is the high risk, high reward play, and it's only for those who can manage risk aggressively and accept that a tight stop means you might get stopped out even if the broader idea is right. The aggressor is entering long at the extreme demand zone around 0.7116 on a 15-minute reversal pattern. Think a double bottom with a bullish divergence on the 5-minute RSI, or a pin bar that rejects the level with a long wick. The entry trigger is a 15-minute close above 0.7122, which would confirm a small structural shift inside the demand zone. The stop loss is brutally tight at 0.7105, just below the 0.7116 support, because if that level breaks, the trade thesis is instantly invalid. Take profit 1 is 0.7150, the initial resistance from the broken support zone, and take profit 2 is 0.7180, the midpoint of the resistance cluster. The risk-reward on this trade can exceed 1 to 4 if the squeeze really ignites, but you must be disciplined. No averaging down, no moving the stop. If 0.7116 gives way on a 15-minute closing basis, you're out, no questions asked. This is the trade that catches the violent snapback when the herd is trapped short, but it demands precision and emotional control. The aggressor, high risk, entry, 0.7122, 15-minute close above demand zone after reversal signal, stop loss, 0.7105 take profit 1, 0.7150 take profit 2, 0.7180 risk, reward, 1:4.1 are invalidation. Void if 15-minute candle closed below 0.7116, now a fast but critical risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news, especially tomorrow's China Caixin Services PMI and any further Middle East headlines. Stops are non-negotiable. They are your seatbelt. This is how you survive to trade the next big move. Discipline is the edge that retail consistently ignores. Let's wrap this up with the single most critical level for the next session. 0.7116 is the axis on which everything rotates. A 4-hour close below it and the weekly structure resets, opening a path to 0.7039 and then 0.6880. As long as it holds, every dip is a potential springboard, and the hidden divergence suggests the bounce could be violent. Tomorrow's wildcard is the China Services PMI release. A strong number out of Beijing and this entire bearish narrative evaporates, crushing late shorts under a wave of risk on flow. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live right now. Tap the end screen and continue your pre-market prep. Smash the like button if this gave you a clear, tradable plan. subscribe, hit the bell, and I will see you in the next one. Trade smart, stay disciplined, and I'll talk to you before the next explosive move.